do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to today's session where we are going to talk about oil, our favorite commodity. This is a daily chart of the world's most widely traded commodity, and as you can see, on Friday we had the largest single drop since this drop, the beginning of Q2, or the end of Q2 2020, when the plague struck. Now this obviously represents the newest variant of the plague called Omicron, which is an interesting name in itself. And we see this, the correlation between plague increase and drop in oil price is intuitive and it's clear. 96% of crude oil is used in the transport industry, and when there is an increase in the deadly plague, there's a decrease in moving around. People don't move around as much. Goods don't move around as much, or at least in the initial phases. When it rebounded, it boom here, but that's a longer-term story. So we see a 10% drop here, and we see a slight pickup in the last, we'll call it 36 hours, because this is viewed as slightly overdone. But to put this into perspective, and this is the perspective I want to offer today for the rest of the week, this has got the world's oil traders' nerves jangling. OPEC Plus put off their meeting, their technical meeting that was supposed to take place today until Thursday. The OPEC Plus group, which is, of course, OPEC, its cohorts, and its major cohort, Russia, until Thursday, at which time they're going to announce whether or not their phased increase in production of 400,000 barrels per day, per month, per day, which is increased on a monthly basis, will continue as a result of this slowdown. As you see, prices for WTI, which we're looking at here, is now $71. Here it was at 85 just a mere week ago. So that's a huge drop in price. As you can see, it's fallen below the, just dancing here on the daily chart, below the 200-day exponential moving average. And that is a major, that's called the death cross in technical trading, when it crosses below the 200-day moving average. So that is a serious sign. I want to also emphasize the stiff spike in volume. This did not happen on low volume. Rather, it happened on high volume, meaning that there's a great deal of sentiment behind this move, and that indicates a conviction on the part of traders that this move is powerful and has legs, as they like to say. So let's just recap. Oh yes, and there's one more detail to throw into the energy mix. Starting today in Vienna, the Iranian nuclear talks are about to resume. For anybody that doesn't live on the moon, it's quite clear that the Iranians are seriously intent on developing a nuclear weapon. They've succeeded in enriching uranium way beyond what's necessary to generate electric power. They're well on their way to 70% enrichment, and the 90% enrichment level for uranium, which turns it into plutonium, uranium-236 as opposed to 234. 90% level is weapons grade. They're on their way. There's hope, at least, perhaps fantastic or delusional hope, that the West will be able to contain Iranian nuclear armament intentions. My doubt is they won't succeed and the Iranians will succeed. But be that as it may, being the Middle East and being the home of hydrocarbon energy, that's part of the calculus as well. So we have a steep drop-off in the crude price, a likely continuation of that steep drop-off. We'll get more facts as the OPEC meeting unfolds toward the end of the week. But in the meantime, ladies and gentlemen, that's the oil outlook. We expect continued fall in the price of oil. And with that, we wish you all, ladies and gentlemen, the ability to trade with confidence. Bye-bye for now.